You wake up on a Tuesday morning. Check your phone. And S&P 500 futures are down 11% before the market has even opened. Treasury yields are spiking in a way nobody alive has ever witnessed. The dollar is falling against every major currency at the same time. And your bank's app keeps glitching because half the country is trying to log in at once. Every cable news channel is running the same headline. The United States of America has officially defaulted on its debt. Most people hear the word defaults and assume it is just political theater in Washington, some negotiation tactic, a deadline that always gets extended at the last minute. And historically, yeah, that has been true. But here is what nobody is really talking about. We are closer to this scenario becoming reality than at any point in modern American history. $36 trillion. That is where the national debt sits right now. Interest payments on that debt have become the single largest line item in the federal budget, surpassing defense spending, surpassing Medicare, and the political environment in Washington right now ranks among the most dysfunctional in generations. So today, I'm going to walk you through, step by step, hour by hour, week by week, what actually happens if the United States defaults on its debt. Not the vague, hand-wavy version, the specific, mechanical, financial chain reaction that unfolds. Because this isn't about politics. This is about your money, your retirement, your mortgage rate, and the price of everything you buy. By the end of this video, you're going to understand something that maybe 2% of the population actually grasps, which is that U.S. Treasuries aren't just government bonds. They are the foundation of the entire global financial system. And what happens when that foundation cracks changes everything. Let's get into it. Before we can talk about what breaks, you need to understand how this machine works. When it is running normally, most people, even people who consider themselves financially literate, don't fully appreciate what US Treasury securities actually do inside the global economy. When the US government spends more money than it collects in taxes, which happens every single year and has happened almost every year for decades, it borrows the difference by issuing Treasury securities, T-bills, T-notes, T-bonds. These are IOS from the United States government. And, by universal consensus, across global finance, they are considered the safest financial asset on planet Earth. That isn't just a nice title, it carries real, mechanical consequences. Treasuries serve as collateral in the repo market, the overnight lending market, where major banks and financial institutions lend hundreds of billions of dollars to each other every single night. If you don't know what the repo market is, think of it as the circulatory system of the financial body. Blood has to flow. When it stops, organs start dying within minutes. Banks hold treasuries as reserves to meet regulatory capital requirements. Money market funds invest in them to deliver that safe, stable return you see on your account statement. Foreign central banks hold them as their primary reserve asset, with China carrying roughly $760 billion worth and Japan holding over $1 trillion. Combined, foreign governments hold over $8 trillion in U.S. Treasuries. And here is where it connects directly to your life. The interest rate on a 10-year U.S. Treasury note is the benchmark, the reference rate, for virtually every other interest rate in the economy. Your mortgage rate is priced as a spread above the 10-year Treasury. Corporate bonds are priced as a spread above Treasuries. Auto loans, student loans, credit card APRs, they all connect back to this one instrument. So when I say Treasuries are the foundation, that is not a metaphor. This is the plumbing, the wiring, the load-bearing wall. Every financial transaction, Every credit decision, every portfolio allocation on Earth connects back, directly or indirectly, to the assumption that the United States government will pay its debts on time. In full, without question. A default doesn't just break that assumption, it detonates it. So how does a default actually happen? Because it doesn't just materialize out of nowhere. The mechanism is the debt ceiling. Congress sets a statutory limit on how much total debt the federal government can carry. And when the government hits that limit, the Treasury Department can no longer issue new securities to borrow money. What happens next involves something called extraordinary measures, which are accounting maneuvers that buy a few weeks or months of breathing room. But once those measures run dry, the government literally runs out of cash. At that point, the Treasury cannot make all of its payments and has to start prioritizing. This is where it gets ugly, because payments flow out of the federal government every single day. Social Security checks, military salaries, Medicare reimbursements, federal employee pensions, interest on existing debt, payments to government contractors, tax refunds. On any given day, billions of dollars are moving out the door. We've had close calls before. Back in 2011, the debt ceiling standoff grew so serious that SEPIT downgraded the U.S. credit rating from AAA to AA+. For the first time in history, and the stock market dropped about 17% in a matter of weeks. A deal eventually came together, but the damage to confidence was real and measurable. Then, in 2023, we went right to the edge again. Treasury Secretary Janet Yellen warned Congress repeatedly that the date, the date when extraordinary measures would be exhausted, was approaching fast. A deal came through in June of that year, but market stress was visible. Bill yields spiked on securities maturing around the date because investors were genuinely pricing in the possibility that those specific bills might not get paid on time. And now the fiscal situation has only gotten worse. The deficit for fiscal year 2024 came in at roughly $1.8 trillion. Interest expense on the national debt surpassed $1 trillion annualized. Congressional Budget Office projections show deficits staying above $1 trillion every single year for the foreseeable future, and the political dynamics in Congress around spending cuts, entitlement reform, and tax policy remain as gridlocked as they've ever been. So when people ask me whether the US could really default, I don't say never. The probability remains low, but it is not zero. And non-zero probabilities of catastrophic events are exactly the kind of thing you need to understand. All right, let's walk through it. The date arrives. Extraordinary measures are exhausted. Congress has not raised or suspended the debt ceiling, and the Treasury Department announces that it cannot make all scheduled payments. Here is what happens. Within the first few hours, before most Americans even finish their morning coffee, the global bond market reacts. Treasury yields spike violently, not because investors suddenly think America is going bankrupt, but because the risk-free rate is no longer risk-free. The entire pricing framework for global finance just lost its anchor. Think about what that means in practice. Every model, every algorithm, every risk calculation used by every bank, hedge fund, pension fund, and insurance company on Earth has an input called the risk-free rate. That input is the US Treasury yield. When that number suddenly becomes unreliable, every output changes at once. Portfolio value shift, margin calls trigger, and hedges that were calibrated to the old framework stop working. The repo market seizes up next. Banks use treasuries as collateral to borrow overnight. And if there is uncertainty about whether those treasuries will actually pay out, lenders demand larger haircuts, meaning they'll lend less money against the same collateral. Some lenders pull out entirely, and overnight funding dries up. This is exactly what happened in September 2019, when the repo market had a minor hiccup, and the Fed had to inject hundreds of billions of dollars to stabilize it. Now imagine that scenario 10 times worse, because the collateral itself is in question. The stock market reaction barely needs speculation. In 2011, during a crisis that got resolved before any payment was actually missed, the Dow dropped about 2,000 points. If an actual payment is missed, we are looking at a crash that makes 2008 look orderly. Circuit breakers would trigger. Trading halts would hit individual stocks, and the entire market could pause. The dollar drops sharply on foreign exchange markets. Now the dollar might not fully collapse, and here is why that is strange. In many crises, investors flee to the dollar because it is the world's reserve currency. But in this crisis, the dollar is the problem. So you could see something truly unusual, where investors flee from the dollar and from treasuries at the same time, seeking safety in gold, the Swiss franc, the Japanese yen, even Bitcoin. Gold prices would likely surge past record highs within hours. And then there is the one that hits ordinary Americans the fastest. About $6 trillion sits in money market funds, and a huge percentage of that money is invested in Treasury bills and repurchase agreements backed by Treasuries. If those underlying instruments come into question, money market funds could break the buck, meaning their share price drops below $1. This happened once before in 2008, when the Reserve Primary Fund broke the buck because of its exposure to Lehman Brothers. And it triggered a panic. People rushed to pull their money out of money market funds. Across the board, if multiple funds break the buck at the same time because of a Treasury default, we're in uncharted territory. And all of this unfolds on day one, probably within the first 12 hours. By the end of the first week, the damage has spread beyond financial markets and into the real economy. Social Security payments stop or face delays, and roughly 70 million Americans receive those benefits. For about 40% of retirees, Social Security represents their primary source of income. These aren't wealthy people with brokerage accounts who can sit through volatility. These are people who need that check to cover rent, buy groceries, and pay for prescriptions. A delay of even a few days creates genuine hardship, and a delay of a few weeks creates a humanitarian crisis among the elderly and disabled. Federal employees and military personnel may not receive their paychecks either. The U.S. military has roughly 1.3 million active duty service members and over 750,000 civilian employees in the Department of Defense alone, all of whom carry mortgages, car payments, and families that need feeding. Their financial obligations don't pause because Congress can't reach an agreement. Government contractors represent a part of the economy most people underestimate. Defense contractors, vendors, construction firms working on federal projects, healthcare providers billing Medicare and Medicaid. All of them depend on federal payments. When that money stops flowing, those companies don't just absorb the loss. They start laying people off and canceling orders from their own suppliers. The multiplier effect kicks in hard. $1 of government spending that doesn't go out the door removes roughly $1.50 to $2 of economic activity from the broader economy. Credit markets freeze up because, remember, everything is priced relative to treasuries. If the treasury yield becomes unreliable and elevated, corporate bond spreads widen dramatically. Companies that need to roll over existing debt or issue new bonds to fund operations suddenly face interest rates that are 2, 3, or 5 percentage points higher than expected. Companies with weaker credit profiles simply cannot borrow at all. And that is how a financial crisis becomes a corporate crisis. Companies start drawing down credit lines preemptively. Banks tighten lending standards, and the credit channel, which is the primary mechanism through which the modern economy functions, begins to constrict. Mortgage rates spike in tandem. The 30-year fixed mortgage rate, which is closely tied to the 10-year Treasury, could jump a full percentage point or more within days. Anyone in the process of buying a home, anyone with a rate lock expiring or sitting in escrow, suddenly faces a very different financial picture. The housing market, already showing strain from elevated rates, takes another body blow. And running through all of this is a psychological dimension that is hard to quantify but impossible to ignore, which is confidence. Consumer confidence, business confidence, investor confidence. Once people believe the system is broken and start acting on that belief, it becomes self-fulfilling. People pull money out of banks not because banks are failing, but because they're scared. Businesses delay hiring and investment. Consumers cut spending. The economy contracts. Not because of some fundamental resource shortage, but because trust collapsed. And this is where it gets really dark. Because the US doesn't exist in a vacuum. About 60% of global foreign exchange reserves are held in US dollars. The dollar is the invoicing currency for roughly half of all international trade. Oil is priced in dollars. Most international commodities are priced in dollars. And when institutions and governments around the world make financial plans, they build those plans on the assumption that the US dollar and US Treasuries are solid. A US default sends shockwaves through every economy on Earth. Emerging markets get crushed first. Many developing countries borrow in US dollars because their own currencies aren't stable enough to attract international investors. And when the dollar becomes volatile and Treasury yields spike, servicing that dollar denominated debt becomes dramatically more expensive. Some of those countries simply can't do it. Sovereign debt crises start cascading across emerging markets, hitting Latin America, Sub-Saharan Africa, and Southeast Asia. Countries that were already stretched thin get pushed over the edge. European banks hold large portfolios of US Treasuries and dollar-denominated assets, meaning their balance sheets take immediate hits. The European Central Bank has to respond, but the options are limited when they're already dealing with their own problems. None of this is theoretical. In 2008, European banks ranked among the hardest hit by the US mortgage crisis, despite the fact that the mortgages in question originated thousands of miles away. Financial systems are interconnected in ways that most people can't see until something breaks. China and Japan, the two largest foreign holders of US Treasuries, face massive losses on their holdings. And here is where it gets strategic. China has been gradually reducing its Treasury holdings for years, partly for exactly this reason. But $760 billion still represents an enormous position. A default would accelerate the Chinese government's push to internationalize the yuan, promote alternative payment systems, and reduce dependence on the dollar. Over the long term, this could permanently diminish America's financial dominance, the so-called exorbitant privilege that allows the US to borrow cheaply because the world needs dollars. That is the part that should scare policymakers the most. Even if the default gets resolved within days or weeks, even if Congress eventually passes a deal and all missed payments are made in full with interest, the permanent damage to the dollar's status as the world's reserve currency could prove irreversible. Trust, once broken, doesn't just snap back. Countries and institutions that spent decades building their financial architecture around the assumption of US reliability will start constructing alternatives. Not overnight, not even in a year, but the process, which has already started in small ways, would accelerate dramatically. The dollar's dominance survived the abandonment of the gold standard in 1971, survived the 2008 financial crisis, and survived multiple debt ceiling standoffs. But an actual literal default might be the event that finally starts the long, slow erosion of dollar supremacy, and that erosion would make it permanently more expensive for the United States to borrow, permanently more expensive for Americans to import goods, and permanently more difficult for the US to project economic power globally. So, where does this leave us? Let me be direct about something. I'm not predicting that the US will default. The most likely scenario, the scenario that has played out every time we've approached this cliff, is that a deal gets struck at the last minute. Politicians on both sides recognize that the consequences are too catastrophic, and they reach some kind of agreement. However ugly it looks, but most likely does not mean certain. The trajectory we're on, with a $36 trillion national debt, $1 trillion annual deficits stretching out as far as the eye can see, interest costs consuming an ever larger share of the budget, and a political system that seems less capable of compromise with each passing year. That trajectory makes the risk structurally higher than it used to be. So what do you actually do with this information? Diversification is not just a buzzword. If your entire net worth sits in US dollar-denominated assets, you carry concentration risk. International equities, international bonds, hard assets like real estate and precious metals, even a modest allocation to alternative stores of value. These aren't nice-to-haves. They're structural hedges against tail risks, exactly like this one. Second, understand your exposure to government payments. If you're a retiree relying on Social Security, a veteran receiving VA benefits, or a federal employee or contractor, keep a cash buffer. I'm not saying panic. I'm saying be prepared. 3 to 6 months of expenses in accessible cash is always solid advice. And in an environment where government payment disruptions carry even a remote possibility, it becomes non-negotiable. Third, pay attention to the debt ceiling timeline. This is not exciting financial content, and it is not going to go viral on social media. But when the Treasury Secretary starts writing letters to Congress about extraordinary measures being exhausted, when the CBO starts publishing ex-date estimates, that is when you want to be paying close attention. Markets move before the default happens. The 2011 downgrade didn't land on the day of default. It came before. The market sell-off came before. if you wait until the headline reads us defaults. You've already missed the window to position yourself. And the big picture takeaway is this: the US fiscal situation is unsustainable in its current form. That doesn't mean the country is going bankrupt. It means something has to change. Either taxes go up significantly, spending gets cut significantly, or the economy grows fast enough to make the math work. There is also the quiet option nobody talks about, which is that the government inflates its way out by allowing higher than normal inflation to erode the real value of the debt. Each of those paths carries enormous implications for your financial planning. And if you're not thinking about which path is most likely and how to position yourself accordingly, you're leaving your financial future to chance. Look, I don't make these videos to scare you. I make them because information is the most valuable asset you can hold. More valuable than any stock, any bond, any piece of real estate, when you understand how the system works. Really works at a mechanical level. You can make decisions that protect your downside without sacrificing your upside. The United States defaulting on its debt remains a low probability event, but it is a high consequence event. And those are exactly the kind of events that most people ignore, right up until the moment it is too late to do anything about them. Stay informed, stay diversified, stay ahead.